Welcome to Risk Management for Beginners. Risk management is one of the most critical aspects of trading. While profits are the goal, protecting your capital ensures long-term success. In this session, we'll define risk management, explore why it's essential, and cover practical techniques to manage risk effectively. By the end, you'll understand how to safeguard your trades and minimize losses, which is key to becoming a consistent trader. Section 1. Why risk management matters. The reality of trading. Trading involves uncertainty. No strategy guarantees profits. Even experienced traders face losing trades. Risk management limits the impact of those losses. Emotional trading. Without a plan, emotions like fear and greed can drive poor decisions. Risk management provides structure, preventing impulsive trades. Survival and longevity. Traders who protect their capital survive market downturns. Preserving funds allows you to trade another day, even after losses. Example, imagine risking 50% of your account on one trade. A loss leaves you needing to double your money just to break even. With proper risk management, you avoid such drastic setbacks. Section 2. Key risk management concepts. Position sizing. Never risk more than 1 to 2% of your trading account on a single trade. Adjust the trade size based on account balance and stop-loss distance. Stop-loss orders.